set up a trade. So the base of the business is all about trade settings. And if you know how to set up a trade, either you are receiving a signal or you are analyzing your own signal. Entries wouldn't be delayed. It will take you less than a minute to place a trade once you know how to set up a trade. So basically, when it comes to the use of RoyalQ, it's all about how to configure the bot. So let me say, if 50% is about analyzing the market, 50% about configuration, how to configure your bots, right? So that is what we are here to do this morning, both on the spot and then also on the futures market. There is nothing so different, there is nothing so exceptional. Just the listings, the few things that you need to know. Once grabbing those concepts, you can consistently or predominantly work on them and become a good trader yourself, right? So my screen is shared. If you can see my screen, give me one in the chat. If you can see, give me one. Let me know if my audience can see my screen. My screen is visible for everyone. Just give me one. Okay. Just give me one. Yes. So that I can know that okay, it's visible. It's visible. That is great. It's visible. Okay. All right. All right. All right. Okay. So long quickly, let's start. Let's start. Please, if you have a downline who just activated, make sure that person is here with us this morning, because make sure that person is here with us this morning, right? Because we don't want situations whereby we will start a session, someone will join late, the person will tell you, I don't understand, I don't understand. There are people too who join the platform and they'll be like, sometimes you realize whatever you've been taught here or whatever we've been taught here, people join the platform, they begin to ask the same question. Not like they join, they're on the same platform and they begin to ask the same question. You see, sometimes when you teach something in the same class, and so there are other students who refuse to be in class, and after some time they keep asking the same question over time. Sometimes it frustrates and it annoys a lot. If you are not such type of teacher who can exercise patience over students, you would always be provoked to do what you are not supposed to do, right? So please, let's try to inform our team members, our downlines, especially the newbies who just joined, that they should join this session because trade settings is important. Okay, so now basically the idea of trade settings in crypto markets, when it comes to spot and futures, we focuses on the sports and futures, the sports and then the futures markets. So I'm combining all the two. I'll first talk about the sports, and since they are similar, I'll just further up and then say something briefly about the futures too. So ideally, when it comes to spot trading, RoyalQ simplifies spot trading and it simplifies trading. And how does that? By providing the inbuilt strategies or the built-in strategies. So RoyalQ BBC, stop using my board. It's not for you, it's for me. Okay. So the inbuilt strategies are there to ensure that traders can be able to understand the bot, configure the bot, and use it. Now, in as much as that we all know, or if you don't know, the spot markets and the futures markets and the entire crypto market is about price fluctuations. Price what? Price fluctuations. And that is the reason why we trade crypto, because cryptocurrency fluctuates. And when we say price fluctuates, it simply means price goes up, it goes up, it comes down, right? So the idea of trading on the spot market using the bots is simple, such that since price goes up and it comes down as well, traders will be able to take advantage over the price differences, how whilst it goes up, whilst it comes down, so that they can be able to generate profits. Now, mostly there are a lot of things that happens on the spot market, and once you understand what happens on the spot market, you are almost passing the result of trading on the spot without complaining of floating loss or any other thing. Why does floating loss exist on the spot market? And this is what I'm taking time to explain. After that, how we work on the spot market, setting up the trade. Okay. So On the spot market, or yes, on the spot market, we know that it's about buying low. The trader buy assets at a lower price and then also sell it at a higher price. Now, when we say you are buying an asset at a lower price and selling at a higher price, recent, I think today, the price of BTC is trading around 108K plus. Okay. Now, the price could go to from 108 to 110K. The price could drop further from 110 to 100 and maybe 5K. So when it comes to the idea of spot trading, you are buying it at a price like this and then sell it at a price like this. But then the fact is, you actually don't know when this price will drop to 105. You don't know when it will rise to 110. Neither do you know. So those who bought the asset at 109K never knew the price could drop to 108 at the moment within a period of time. So their anticipation was to expect that the price would go from 109 to 110K or 11K. But fortunate or unfortunate, the price dropped from 109 to 105, which simply means you are running a loss per income or per capital. Since loss has been incurred here, it happens that the amount of money that you've deposited or the amount of money that you've invested in the funds, because on the spot market, you automatically own a share or you own the asset, right? And since you own the asset, okay, um so since you own the asset on the spot market, all right. So since you own the asset, since you own the assets on the market or you own the asset yourself, when the price goes down, automatically your price or the value would also do what? The value of the assets you bought will also do what? Go down, right? So this is the idea of trading on the spot market and how to apply the strategy. That is the Martingale strategy that we've been using on the RoyalQ. So over here, I know I bought the asset at 108. The price is capable of going to 108, 111, okay, or 110. But the price can also go down before it hits my target of 110. So it could drop from 108 to 105. Okay. From 105, instead of it to rise back to 110 or 108, it dropped from 105 to maybe 103. Which simply means, in an actual sense, yes, you are running losses because it is going against you. But since you decide not to sell the assets because you are in anticipation to make profits, you bought the assets because you want to make profit, not loss. So what happens to a lot of spot traders is panic selling. Most traders somehow decide to sell his assets because he bought it at 108 and now the price has dropped from 108 to 105. Even in its anticipation that the price could go up, it now went further from 105 to 103K. You see, if this happens, you may panic to sell your assets. And when you do that, it's simply because you don't understand price fluctuations, how prices fluctuate, how prices goes down, and how prices comes up or goes up, right? So in this situation, what we are going to do is, because I have maybe $100 that I want to use to trade. And since I have $100 to trade, maybe I have to use all the $100 to buy BTC. In this case, I'm not going to use all the $100 to buy the BTC, but because I have my RoyalQ account, I can apply my nice strategy called dollar cost averaging. Okay, I can apply dollar cost what averaging. Now, in the application of dollar cost averaging, that is DCA. So whenever you see DCA, that is dollar cost average or averaging. Okay, that is reducing or pre-buying the assets at a reduction price. So while the price keeps going down, the trader sees the opportunity to buy more in addition. Right. So the idea of the dollar cost averaging is simple. Now let's look at it and why RoyalQ benefits or provides that strategy to ensure that traders can be able to do what? Win more. Okay, let's look at it. So let me clean the board. And I believe I'm simplifying this for my traders to enjoy the session. I want to simplify this without complicating any lesson here. I just wanted to make it so brief and short and brief so that you can be able to understand. So dollar cost averaging. Now, we are still using BTC as a typical example, and we'll practice this on our RoyalQ. So over here, the price of the asset is 108K. Now it dropped from 108 to 105. From 105, it drops to 103. From 103, it drops to 102. Then maybe it rose back to 109, right? So this is where we making the profits. So I have $100 capital. The idea of dollar cost averaging is that I'm not going to invest all the $100 in the trade, but I'm going to use a strategy to ensure that I can strategize, divide the $100 into different sessions, which can ensure that I'll buy the asset at a lower price. As the price keeps going down, I'll be buying it at its lowest point. Mind you, the person who bought it at 108 wasn't 100% sure or aware that the price could go down to 102. Neither will it drop to 103 or 105. But you are applying this strategy because you know that there is what we call price fluctuation. The price goes down, it comes up. So while someone is in a hurry to use all his 108 and $100 to buy the asset at 108, you would divide your capital into different portions or different values to be able to enable you buy it at the lowest point as it keeps going down. When it goes up to, that is fine. Are you following? Are you following? Are you following? Are you following?
Yes, yes.
All right. That is good. Very good. All right, let's proceed. Okay. Now, over here in RoyalQ, dollar cost averaging, it's simple. So it's just about buying the asset at each lowest point whilst it goes down. Now, the thing is, RoyalQ has provided two different strategies for you that you can apply your dollar cost average on. The first one is called Martingale. The first one is called Martingale, and the second one is called Grid. Grid. Okay, so these two strategies all is about the application of what dollar cost averaging. But dollar cost averaging can be applied in different sense. And over here, RoyalQ provides two aspects of it. That is the grid and then also the martingale. So we are going to talk about martingale this afternoon or morning or evening. We are only talking about the martingale today. Maybe in one of our advanced sessions, I have to talk about grid. So when you talk of martingale in dollar cost averaging, over here, the idea of martingale, it's simple. It's about doubling and tripling the cost of the assets. Doubling and tripling, okay, down the costs of an asset. So those of you who couldn't join the Thursday session, this is the actual meaning. This is the actual breakdown of the tripling effect we talk about. Okay, because this is truth settings. Mind you, that was an advanced session. This is truth settings, so I'm taking time to explain it better here. So pay attention to this. So the idea of Martingale in dollar cost averaging is about doubling or tripling down the cost of an asset. And when we say doubling or tripling down the cost of an asset, because it is derived from the dollar cost of averaging. So over here, the idea is that when the price goes down, so let's assume it is 108K. We have $100. We bought $10, okay, as 108K. When the price goes down to 105K, we are to double our first result, right? Which is times 2, which is going to give us what, 20. So this time round, when the price goes to 105, we are buying $20. So we are doubling the effect of each result. So when the price goes down to 103K, we are doubling the next one, which is times 2, giving us 40, right? So 10 plus 20 plus 4, so everything is going to be how much? 80. Is it 70? Right? Good. Now the next one is what? Is 100 and let's say 100K. So we are still going to double it. 80. Very good. So in this case, from 108K to 100K, we are doubling the effect. Now, what is the essence of doubling the effect? Mind you, if I've been able to buy $100 at 10, 20, 40, 80, the result is this. Please mute your call. Mute your call. So whoever talks, just do the needful, mute the person. If the person misbehave, we remove the person from the chat. That is all. Once the person misbehave, we remove the person. Very good. All right, let's proceed. So over here, the idea is simple. Let's go back and share. All right. So the idea is for me to be what? For me to double up my my strategy or my results. So the first one, 108, the second one, 105, the third one, 103, the fourth one is 100. Okay, good. So over here, 10. The next one is 20. The next one is 40. The next one is going to be what? 80. So I keep doubling my effect. Okay, the effect of my results is being doubled. So anytime the price goes down, I double up my capital to buy more. So instead of buying it at $20 at 10K, 108K, I decided to buy $20 at 105K, which simply means my result here will be increased as compared to this. When this happens, I am not wasting my $100 on this 108K, but I've double and dollar cost on what I've averaged on the cost of what each price. So the average price, which is $100, 103, 105, I've been able to take advantage over them. Now, when this happens, because at each price, mind you, this is the new average price. When we talk of the average price, that is the price at which I bought the asset. That happens to be my average price. But looking at this, you could realize that the average price was 108. Now it is 100 and what 105. When this happens, I've been able to create a very slow gap between 105 and 108 because my results here is bigger or higher than the results here. The price at which I bought um it at 105 is bigger than the price at which I bought $10. Do you get it? So the more I keep buying it at a higher price, the more I draw the average price closer to the current price. We will express that or we will see that on RoyalQ. Now, so this is the doubling effect. Okay, the doubling what? The doubling effect of the Martingale. And then let's look at the triple. So it's the rule still follows the same principle. It follows the same principle. So let's look at it. Good. So we also have it here. Now let's assume it's $200. So with $200, we have everything here. Now I decide to buy, okay, let's assume $5. The next one is going to be how much? We are tripling it. So at each result, we triple it. So if $5 is here, the next one is going to be $15. The next one is going to be $45. 45 times 3. What will be 45 times 3? What will be 45 times 3? Give me the answer in the chat box. 45 times 3.
135.
Drop your answer in the chat box, please. We are recording the session, so do not talk. 45 times 3. You can drop your answer in the chat. 135. 135. 135. Okay. If that is correct, I'm using your results. Okay. I'm seeing 135. Okay. So over here, you are going to get 135. Now let's add everything to see if it's up to 200 or it's more than that. Okay. So let's see 135 plus 45 plus 15 plus 5. Let's look at this. What will be the total answer? What will be the total answer? Drop your answer in the chat box. Drop your answer in the chat box. 135 plus 45 plus 15 plus 5. Drop your answer in the chat box. Drop your answer in the chat box. It's how much? 200. 200. Very good. Very good. 200. So you see how you've been able to utilize your $200. So mind you, you see when you come here, oh, this thing keeps vanishing. Let me, don't like on sharing this thing at all. Okay, that's fine. Let me share and reshare again. All right. So now, when this happens, you realize that you didn't just go into the market for the sake of I want to buy more. If you want to buy more, we don't just buy more, we buy more with sense. Do you get it? We buy more with what? With sense. So you see, the idea of going into the market, I want to buy 200 margin calls. 200 margin calls, your capital two is small. Meanwhile, you want to buy $200, then you keep buying, you buy 10 what do we say, $2, $2. I want to buy $2, $3, $5. No. Instead of doing this, the actual strategy that RoyalQ, if you like, let's go to RoyalQ. When you go to RoyalQ now, you see how it works there. So you realize that the application of Martingale has already been demonstrated using the bots, right? That is the reason why sometimes when you just take your time to observe the default setup of the bots, right? Take your time to observe the default setup of the bot and you will understand what we are talking about. Okay, you understand what we are talking about. So let's look at it. Let's go to our exchange, sorry, Binance, oh, RoyalQ. So quick. All right. So on sports, if you want to trade on the sports market, first we get an asset, right? We tap on the name of the asset. Okay, click on create. So over here we have Martingale and then Grid. Martingale and then what? And then Grid. So the strategy we are going to use is this. So we are going to use Martingale strategy. So you click on Martingale, you click on create. I understand. Then you click on trade setting. Now, having this in mind, you've done all your necessary setup. First, click on what we are looking at margin configuration. That is where we are talking about now. So later we get back to all those things there. Now, look at this. We have 2, 4, 8, 16, 32, 64. What does it mean? What is RoyalQ doing? Mind you, this is default setup. This is what? Default setup. I don't know if you understand what you are saying. This is a default setup. Default simply means that is what the bot itself is providing. System generated. This is a default what? A default setup. Now let's look at it. What is the interval? This is mathematics, simple mathematics. What are the intervals and what is the rule? This is what we are saying. It is the doubling what effect. It simply means 2 was doubled by 2. 2 times 2 will give you 4. 4 by 2 will give you what? 8. 8 by 2 will give you 16. So the doubling effect, you keep doubling your next result. 16 times 16 or 16 times 2 will give you 32. 32 times 2 will give you 64. Is someone learning? That is how come they managed to get this result. That is a doubling effect. So what previously we used terms as the double up, right? So they keep doubling the effect of the next result. And why this? Because anytime the price goes down, you are expected to buy higher as compared to what you bought next, what you bought previously. Sorry. So if I bought $10 here, I am expected to buy times 2 of this $10. That is what can help me to get out of floating loss, or that can help me to make more profits in addition with my capital. Is someone learning? That is the reason why most people jump into floating loss and yet they don't make any serious profit. After all the long while you'll be in floating loss, you wouldn't make any serious profit because you are not using the actual strategy or the actual concepts that you need to learn and understand. And the second thing is, if you keep doubling your results, because you'll be creating new average prices, it can help draw the average price closer to the current price very fast. You yourself just imagine you bought $10 first, and now you are buying $2 in addition, $3 in addition, $4 in addition. Just imagine. Just imagine. Hmm? You see, when the weight is going down, your value must increase. When the weight of the asset is going down, the value of your price must increase. So the price which is at 108 is the weight. The value at which the cost at which you bought is $10. The weight is going down from 108 to 105. You must increase your value, not decrease it. If you decrease it, it is affecting the rate at which it has to move, and then also the profit you have to make. Mind you, who wouldn't prefer to go into a market to get assets at a lower price and then decide that, okay, since I bought the first one at an expensive price, I wouldn't like to buy this because the price is still no. When the price is cheap, That is when you have to increase your value of buying, because that is where the profit will be allocated. Do you get the concept? Do you get the concept? Do you get the concept? Let me know if you get it. Do you get it? 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 Let me know, let me know, let me know. Is someone here listening to me? Let me know if you get what we are saying. Let me know if you get what we are saying. Very good. Very good. Very good. Okay, Wheezy is saying he doesn't understand. Wheezy. Wheezy is saying he doesn't what? Understand. He doesn't understand. So for the class to be a little bit collaborative and more introspect, I would like to give Wheezy opportunity. Wheezy, let me know which part of it that you don't get it now so that I can punch more on that. Which part of it? I'll give you the room for you to ask your question. Either you write it or you raise your hand. Wheezy, I'm referring to Wheezy, not everyone, but Wheezy. Okay? Wheezy, if you can raise your hand, I will really appreciate so that I know the part that or the area that you don't understand so that it can be more interactive. I guide you better to understand. Because you are moving forward. So Wheezy, let me know in the chat if there is a part that you don't understand. You said you don't understand. So let me know if possible. All right. Okay, so I'm proceeding. If maybe when you're ready to raise your hand, I'll be there. Then also when you type your question in the chat box, I'll get back. All right. On the doubling part. So Wizzy is saying on the doubling part. Now, what we are saying is simple, a simple rule. Look at the default setup here. This is the default setup. Okay. I'm cleaning everything. I'm cleaning everything. For your sake, I'm cleaning everything. Good. Now, what we are saying is this. This is the double. We are the doubling part. We are moving to the tripling. So let me take time. It's just this, the tripling and the doubling are the same. Now listen. What we are saying is RoyalQ, even providing the default setup, they provided it Martingale based on the Martingale strategy on default doubling strategy, right? Now, double simply means that your next action of buying, the price at 108 was $10. When the price drops and you want to buy again, double your first price to 105. Double the price at 20. That is 10 times 2. That is going to give you 20, right? Now, when the price goes down to 103 and you still want to buy, double this value. So 20 times 2 may giving you 40. So this place is going to be $40. When the price goes down again at 100 and you want to buy again, double this times 2, giving you 80. So the more it goes down, the more you double the value of buying. So from the first onset, you bought $10, but the last one, you bought $80. Look at the distance. It simply means the value at which you preferred buying $100 is higher as compared to $80, as compared to $10. Now, you never run loss because at the end of the day, you even end up making huge profits because the price of 100 is 100K is higher at which you the price you bought it at 100K is higher as compared to the price at which you bought it at 108K. Which simply means if let's assume your we'll look at the take profit allocation ratio. If you are to make profit on each, that is 1%. Mind you, your profit here would be more expensive or will go high as compared to 1% on $10. Do you get it? Because I bought this one 100K at $80. I bought $80 of it, and this one I bought $10 of it. So if I'm to make 1% on each drop, mind you, I'm going to make 1% of $80 as compared to 1% of what? $10. So this is what you mean to buy the dip and make profit in the dip. I don't know if someone get the concept. I don't know if someone get the concept. Do you get it now? Do you get it now, Wheezy? Yes, it's being recorded. Very good. So you get it now. Please, how do you get this? A 3.5. We are not there yet. We are not there yet. So just chillax, 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 my brother, chillax. Eh? Get an ice cream, a cold ice cream, maybe the blog one. Just drink it and then also eat it and then also chillax. Just chillax and keep following. All right. Okay, so let's let's proceed. Now, you see, even with the doubling, you can see how profitable it may be if you have good capital. So those of you that were having, yes, it will buy automatic so far as you've done the setup. You're not going to buy it manually. It's buy it automatic. So you see, even when you've got the you are using the doubling, just imagine the profit you'll be making. Those of you, there are some people with $500 capital, $1,000 capital, and you see them, they are not making any profit in the dip, and they've been in floating loss for decades because you missed the idea of Martingale. It's because you missed the idea. Hmm? So now, if with a double you are making profit, it simply means with a tripling effect, you will make extra profit. So let's look at the tripling effect. So this time round, it's not going to be 2. So let's look at it. If I am to double 2 times 2, give me 4. This time around, it's going to be 2 times 3. So 2 times 3 will give you what? 6, right? 6 times 3 will give you what? 18. 18 times 3 will give you what? So give me the answer. Drop the answers in the chat for me. 18 times 3. Let me check if my people are there. 18 times 3, 54. Very good. 18 times 3, 54. So the next one is 54. 54 times 3 times 3 will give you what? 54 times 3? No. 54 times 3? 162. 162, right? Let me see. 162. Very good. So 162. 162. So let's assume this is okay, good. So 6 plus 18 plus 54 plus 162, right? That is the tripling effect. The tripling what effect. Now, mind you, you don't need huge capital. It's about taking your time to calculate. Take your time. First, do the calculation before you open the trade. That is the reason why I've been saying that when it comes to trading, first decide on the capital to expose before you make entries. You don't make entry before you decide on the amount to expose. You don't make entries before you decide on the amount to do or to expose. So let's see the tripling of maybe $100. Let's see tripling of what of $100. So it simply means over here, let's see 1, You are using 100. So let's see, you are using $1. So first one you are buying $1. So the second one is going to be 3. The next one is going to be 9. The next one 9 times 3 times 9 3 27. 27 times 3 is how much? 81. If I'm right. So let's look at it. So over here, that is how it's going. So check it out. Right? So let's add. This plus this is going to give you 10, 30. So in total, you're going to use approximately how much? Do the calculation and give me the answer. 1 plus 3 plus 9 plus 27 plus 81. Do the calculation and give me the answer. Do the calculation and give me the answer. Do the calculation and get me the answer in the chat. This is it. 121. 121. Very good. Now, listen, it is not how it's not about buying plenty margin calls. Listen, if you buy plenty margin calls without any sensible calculations or without any other orderly calculation, you may end up making nothing. You may buy the dip and you will never make profit in the dip. I don't know if you get the idea. You buy the dip and you will never make any profit in the dip and you will still be in floating loss. And the light out. Yeah, someone. All right. You see, you buy the dip without making any profit in the what? In the dip, right? So you need to understand that it's not about buying 100 margin calls. You buy 100 margin calls and there is no formula binding or governing your 100 margin calls. You end up making nothing. Right? That is the idea. So let's look at it. So over here, I guess you are following. Over here, let's look at it. Maybe I want to buy the first one, um, 1, and the next one is going to be 3 times 3. Next one is going to be 9, 27. So I keep multiplying each price by 3, right? That is the reason why we are getting 27 times. Do you get it? So the next one is going to be 81. So averagely, I'm using this over here. So if more, 81 times 3, 81 times 3 give you how much? 81 times 3. 81 times 3. Let me see. 245. 243. Okay. 243. Okay. So 243. Now, this is simple. Hey, 81. 81. Okay. 81. Then 243. Now, when this happens, at the end of the day, you are making consistent what profit. Like I'm saying, it's not about how long or how tall you buy all the margin calls, but it's about how effective it is. Do you get it? It's about how effective what it is. Now, back to the margin call drop. Back to the margin call drop. The margin call drop is determined by one, how you've analyzed the assets and how fast the price could drop, right? How you analyze the assets and how fast the price could drop. So for instance, when we talk of the core drop, this is how it works. So let's go to our trading view. Observe this. So for instance, I just want us to make a rough analysis here. Let us make a rough analysis here. Okay. So for instance, maybe we have this. So let us assume, okay, let's do this quick. Let us assume we have this here. Okay. So let us assume we have this here, and also we have this. So let's use this, right? Okay. Now, when we talk of the call drop, this is how it works. So assuming we're just making this just a rough sketch. I'm not drawing an exact support and resistance, so don't worry. Assuming you've been able to draw and you want to maybe um okay, okay, very good. So let's use the price range. So let's assume you want to take a profit of maybe on an uptrend, you want to maybe take a profit from this to, let's use this. Okay, let's use this. Maybe this is your take profit direction. This is just a rough sketch, so don't worry. You want to take a rough you want to take profit of maybe 25%. Now, within the 25%, you possibly know that the price could what? The price could easily drop. Okay, the price could easily drop. As a result of that, you are still taking a decision that when it happened that the price couldn't go up, but rather it comes down. Oh, this but rather it drops. So instead of it going up as in this, it could, there is a probability that it could also drop like this. So you are also taking a drop. This is where the challenge of stop loss comes in. That the person thinking that okay, the price could go up. If it couldn't go up and it drops to this point, I want to close the trade. But the person using the call drop is saying that okay, when the price goes down further, I would like to use this opportunity to buy within this range, right? So now let's assume, okay, let me clean this and then use the same price range. So in this case, if I want to use the range again, so let's assume this is where I want to check out on my call drop. Let's look at it. Right. So I'm also going for a drop of 24%. So when we talk of the drop, it simply means this total drop. If it happens that you take profit, it's going to be 25% of the entire. And then for also if it happens that it drops, that is 25 24%, right? So over here, the core drop is 24%. So when I come here, what I'm going to do is simple. So what I'm going to do is simple. I have to make sure that the entire drop here should sum up to 24%. It's simply when the price drops, have a total drop of 24%, I want to be buying at each drop within a particular value. So when you look at this particular one as an example, you could realize that, let me clean this. You can easily realize that the price is going to have a total. Let's do the calculation together. 3.5 plus 4 plus 4.5 plus 5.2 plus 8 plus what? Plus 10. Plus what? Plus 10. Do the calculation. Do the calculation and let's see. 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 I'm waiting for you. Are you doing it? Are you doing it? So 3.5 plus 4 plus 4.5 plus 2 plus 5.2 plus 8 plus 10. Now, do the calculation. Let me teach you the secrets behind this. Do the calculation. Let me teach you the secrets behind this. Do the calculation. Let me teach you the secrets behind it. Let me see. What's the total drop? Okay, 35.2. Someone also got 37.2, 35.2, 35.5, which is which? Which is which? Which is which? I'm getting three different answers. Three different answers, which is which? So you to drop yours. About 47 people on the call now. Drop yours and let me see. 35.2 is the correct one. Okay, to drop yours and let me see. 35.2. Want to say 35.2. Okay, drop yours. Let me see. 35.2. Okay, all right. Now, so it simply means this particular asset would, if it happens that it couldn't go up as expected, there should be a drop of what of 35%, right? Now, you could see that there is an interval. You could see that there is what there is an interval from the first to the fourth call. You could see that there is what there is an interval of what of 0. What 0.5. Is it 0.5? No, an interval of 1. So 3.5 plus 1 will give you, the first one was 3.5 plus what? Plus 0.5. That is what is giving you 4. Plus 0.5. That is what is giving you 4.5. Right? So from the first to the fourth call, it was using an interval of 0.5. I don't know if you get it. If you study this trend, this was addition of 0.5. That is what gave you 4. Plus 0.5 give you 4.5. Right. So from the first to the third. Now, the reason is from the first call to the third call, the market can easily buy the asset, or the asset must easily be bought. So whilst it keeps increasing, you must widen your drops so that it wouldn't buy it anyhow again. Are we learning? Are we learning? Are we learning? Are we learning? Let me know if the message is home. Let me know if the message is home. Are we learning? Are we learning? Yes, very good. All right. That is awesome. So let me use this opportunity to thank my brother who voluntarily bought this. It's lights out and I'm about to I'm enjoying it now. Okay. Yes, it's light out. Just not long ago it's light out. I don't know why. It just gave just light out just now. And you can see the battery was running down. So God bless him once again. All right, let's enjoy the session. Now he has helped us enough. If not, we would have to end the session today. All right. So what we are saying next is this. When you study the interval, you could realize that the main secret or the main reason behind this, behind the drop, is also simple. Even though our total drop may be 24, the first even though our drop may be 24, right? But what we are saying is that even if it's 24, from the first, second, third, and if possible, the fourth call, the gap shouldn't be too wide. If there should be any gap, it should supposed to be at most 1% wide. And then the fifth to the last call, if you have anything to increase, that is where you are supposed to increase it, because it shouldn't be dropping anyhow. You are not supposed to be buying it unnecessarily. Because mind you, you are supposed to buy it at an expensive, at a lowest price, so that you can also buy very high. Just imagine when you drop from just 4%, you can see that the interval wouldn't be so huge. But you want to get it at a lower price so that you can do what? You can make huge profit. I don't know if you get the idea. Do you get it now? Do you get it now? Do you get it? Do you get it? Oh, I should repeat. Do you get it? What we are saying is this: from the first to the fourth call, the interval shouldn't be too wide. So, for instance, um, you bought, you can see the interval is just 0.5 from the first to the fourth. So this time around, I said add the fourth one. So from the first call to the fourth call, the intervals is not supposed to be too wide. But from the fifth to your last call, why must it be wide? Because you are going to buy them at a higher price or a huge price. Look at, you are going to buy this. Look at it, 81 times, 27 times, and then also 243 times. Looking at this, you realize that you must buy it, like the price must be very low. If it is 108 that you bought it. Now, this time around, you are not supposed to buy it at 105. You are waiting for the price to get to like 96K before you buy it at $80. Now, you've understood the reason why most people get into floating loss easily without even making profits. Because they bought, all the drops were too close, and they bought everything very fast, which led them into floating loss.
Shirashaba zinabasa paya man. 2 seconds man. Yeah.
You join call, you refuse to mute yourself. Are you in a meeting? Hmm? Or you just thrown the phone elsewhere? So, Darlington, do you get it now? Darlington, do you get it now? Darlington, do you get it now? I just explained. Do you get it now? Very good. Very good. All right. Very good. Mm-hmm. All right. So now we can proceed. Now you can proceed. So after having all these things here, after having everything clearly done, you are safe to go. After having everything clearly here, you are safe to go. So you come here. Let's see if you will do something. Maybe 2.5. The next one, 3 point what? 3. Then the next one is what? Is 0.5. 0.5, right? So the next one is 4, right? Good. So now from this, we can decide to do what? Increase the rest, the interval. Percy, if you don't behave, I'll remove you. I'll remove you. If you don't behave, I'll remove you. If it's unintentional, be very careful. Be aware of what you are doing. Mind you, you are in a meeting. So if you know you can't stay in the meeting, you have to leave. Else I'll remove you. All right. So the next thing that you have to do, you can see now you have your fifth call. So the wide, it's okay. Okay, the interval is standard, right? The interval is also standard. So if you decide to maybe make the next interval to be 2 or 3, that's fine. So 6, and then the next one is what? Is 8. right? So let's add everything to see what will be the total call. 2.5 plus 3 plus 3.5 plus 4. So do the total calculation and let's see the result. 2.5 plus 3 plus 3.5 plus 4 plus 6 plus 8. Do the total calculation and let's get it right. What is the total call drop? Yes, 27. Hey, some are getting 28. Some are getting 31, 27, 28. Please check it again. 2.5 plus 3 plus 3.5 plus 4 plus 6 plus 8. Check it again. 27. 27, very good. Which simply means when the price totally, when it drops 27, when the total drop of 27, it's going to buy all. 27 is correct. Very good. So after this, you come here, you confirm. You've confirmed everything. Now, mind you, when you get back here, we have the sub position, we have the whole warehouse mode, sub-in mode, and sub-in real-time settlement. So on the spot market, the best play that can suit you is the sub-in real-time settlement because that interval you've created and then the profit you anticipated to make, you must end that profit without any confusion. So you place your note on sub-in mode real-time settlement. Sub-in mode real-time settlement. Is that okay? Is that okay? So you have that, then confirm. Very good. Now you come to your margin multiple buy-in callback 0.1. At least 0.01. So make it 0.1, 0.1. And then the callback to the take profit callback to be 0.1. Right? After that, you come here, you click on, you change the strategy period from cycle to one shot. From cycle to one shot. Then the first buy trigger condition, let it be on trigger price as it is. Let it be on trigger price. If it happens that you have a preset price, that is when you can enter the trigger price here. When we say the trigger price, the price at which you want the trade to be bought. So let's assume the current price is 108. 108. BTC is 108. But you want to buy it at, let's say, 103. So your trigger price condition will be here. This is your trigger price, right? That will be the value of your trigger price. So you will enter it here as 103, just like a preset price. A preset what? Preset price. So this will be your preset value. That is 103. That will be the trigger price. Do you get the idea? Very good. Very good. Now after that, you click on save to save it nicely. So click on save, then confirm. Very good. After that, you are done with your trade. You activate the trade. You are done with the trade. You do what? You activate the trade nicely. Then you go your way. Then you do what? You go your way. Do you get it now? This is for spot. This for spot. One, listen. The margin configuration we just did is for both spots and then futures. The margin configuration is both for both spots and then what? And then futures. Now let's go back to futures. Let's go back to futures. Hope you get it now. Please, I didn't get you. Which part? Which part? Let me know. Say, please, this area I didn't get you. So now let me go back. Um, so over here, what I'm saying is click on advanced settings. Over here, just come here. This is 0.1. It's automatic. Just make it 0.1 and go your way. Then 0.1. Now, when you get here, we have the trigger and click on the strategy period. On strategy period, change it from cycle to one shot. Now, the difference between the cycle and one shot is simple. The difference between the cycle and the one shot is simple. There's when you place a trade on cycle, it simply means you are anticipating to buy more after the trade is closed. So when the trade closes, the strategy will be used again to buy. So let's assume you bought it at 108 and now the price is at 110. When you make your profits here on 110, it will still buy it at 110 and then also sell it at 112. Until then, you are never going to make profits when the price is going down. That is for cycle. Even though cycle is good based on conditions on other assets. If you have a specific asset that you think you want to place on cycle, that is fine. Then one shot simply means after the trade is sold, you want it to be you want to get back again to set it up yourself, right? So you place on one shot. So that is hope you get it, you get this part. Now come to trigger price. When we use trigger price, just like you are talking about market price. So when we talk of trigger price, that is a price at which the trade will be bought. So if you want the trade to buy it exactly at the current price, which is 108, then use trigger price. If not, we have below here, we have trigger price optional. This is the optional. So for instance, maybe you want the trade to be bought at 105 instead of 108. This is the current price, 108. But you want to use 105. Then you come here and enter 105 here. 105. So 105, right? That is the trigger price at which you want to buy. Do you get the idea? So after that, you click on confirm, and that is all. Simply means when the price drops to 105, it will buy. That is when it will do what? It will buy. All right. Hope you get it now. Hope you get it now. How do you get this interface? I don't know which interface I'm talking about. Maybe we are all using this trade settings. We just got here. This is trade settings. Click on advance. Advance. Over here, this is it. Click on what? Advance. Where is it? Advance. When you click on advance, you will see it there. Below, we have the values there, right? That is all. Then you click on save, confirm. Is it okay now? Darlington, do you get it now? Do you get it now? Can we proceed? Can we proceed? Can we proceed? Okay. All right. All right. Oh, okay. All right. So you get it now. I guess we can proceed. All right. Now, this is for the spot market. Mind you, when it comes to the margin configuration, it's for both spot and futures. The margin configuration is for both the spot market and then the futures market, right? So let's look at the futures slightly, something slightly. Now, let's assume you want to trade this particular asset. Click on create. After clicking on create, you can see we have long and then short. Long and then short. Long simply means you are predicting the price to go up, and short simply means you are predicting the price to go down. That is all what it means. Long simply means the trader is predicting the price to go up, and short simply means the trader is predicting the price to go down. Right? Good. Now, the next thing is this. After clicking on short or long, so you come to trade settings. After getting to trade settings, you click on, we have the smart create and then the manually create. The smart create and then manually create. Come to manually create. Over here, this is the only thing I'll talk about, then we bring the session to an end. I'm already exhausted. So you can see we have this. This is what I'll talk about. Then we bring the session to an end. The most important thing about the futures market is how to do the calculations. Since we've already done the margin configuration, I will not touch that part. So over here, you can see we have 1.7 APT, right? Which is equivalent to 5.2864. 5.2864. So let's assume I want to use 100
let's say $10 to trade. In my exchange, it is $10. By over here, it's going to be 100 because maybe I'm using a leverage of 10x. So before you decide on the capital, decide on the leverage. So maybe I'm using 10x, right? Which simply means if I'm using 10x, over here it has to be 100 USDT. So 1.7 divided by 5.2864 times 100. Where from the 100? The 100 is the 10 times 10. My capital is $10 and my leverage is also $10. That is what is going to give me the 10 times 10, which is the 100. So let's do that calculation. Let's do that. Get me the calculation. Can you get it for me? Get it for me. Let me know. 1.7 divided by 5.2864 times 100. Times where from the 100? I said the 100 is the 10, which is your capital times your leverage, which is giving you 100. So it's simply here is supposed to be 100. So for you to get the actual value of one of APT, that is the reason we are doing this calculation. So do that and give me the answer. What's the answer? What is the difference between 0.01 and 0.1 on the settings? Okay, 32.16. 32.16. Okay, so now when we talk of 0. Let me explain this before we proceed. When the price goes up and drops 0.01, you want it to be sold at your take profits. Or when the price drops to 0.1, so this is the drop, okay? And you see 0.01 is a little lower as compared to 0.1. So when the price drops to 0.1, you want it to be sold, or when it drops to 0.01, you want it to be sold. That is the meaning. So it's either you choose the lowest value or a high value which can reach the target very fast. So 0.1, it's okay as compared to 0.01. That is just by the way. Now, over here, it's 32. You said it's 32 points what? Let me see. 32 points. Is it 32 or? Let me see. 36.16. 32.16. Okay. 32.16. So let's come here. 32.16. Okay. So let's assume approximately 32.2. Good. So 32.2 is giving us 100 USDT. 100 what? USDT. It's giving us 100 USDT, right? So since you have 100 USDT, you come here, you take profits maybe 1.3. That one, it will depend on your analysis or your signal. So 0.1, 0.1, 0.1. Then come to optional, you change it from cycle to one shot. The same thing applies to the futures. The futures, if you have a preset value, you can enter it. Then after that, you click on what? You click on save, then confirm. After that, you are done. Click on save, you click on confirm, then you click on activate. Then you click on what? Activate. Now, briefly about the smart create. Now, the smart create is a default setup, right? So over here, it's a default setup to which you can based on the parameters. So when you click on show margin configuration, so over here you can see it's a default setup. When you talk of the smart grid, that is the default setup of the bot, right? So when you click on enter parameters, it will take you to manually create. Do you get it? Once you click on this enter parameters, Once you click on enter parameters, it will automatically take you to smart create. If not, the smart create is the default setup of the bot, and the only thing you can change is your value, your entry price, and then your leverage. That is the only thing you can do it. You can change, as well as the multiples at which you want to buy. If 9, then you get it. That is the idea. So the smart create is something simple. That is a default setup of the bot. That is how the bot has been configured to suit your trade. All right. So always prefer the manually create. Come here, do your own setup, and then find your way out. Okay. So let's end here. If you have any question, let me know if there is any question. Okay. Let me know if there's any question. The meeting is recorded, and at your free time, you can go on YouTube to watch it as well. The meeting is recorded, and at your free time, you can go on YouTube to watch it as well. We've spent good time here together, and I believe you've learned something good. Have you been able to learn something good? Have you been able to learn something good? Have you been able to learn something good? Very good. Very good. Very good. Okay, so Afonso, I don't know if your hand is up. Oh, okay. All right. So that is good time with you. Yeah, that is good time with you here. And if God permits, we shall meet this evening for business presentation by Coach Mo or either Chadwick. So, ladies and gentlemen, this is where time is permitting us to end our session. We shall meet again. I still encourage each and every one of you to keep learning and keep growing in this industry. And I believe with time, you shall also get to your limits. And a time will come, you will also be here to teach other people how to trade, how to set up their, configure their bots as well. All right. In as much as that, try your best enough. If you've not been able to watch our technical analysis session, go to the YouTube channel, go and watch all the sessions there, and then also learn from them. It's possible. If possible, try to join the morning sessions that we've been handling 4:30 Ghana time. 4:30 a.m. Ghana time. That one will also help you a lot in terms of technical analysis. So, ladies and gentlemen, we will end here and meet another time. God bless you and have a good day. Mind you, the market is bearish. So be cautious of how you trade. Be cautious of how you trade. Right? Okay, I wish you all the best in your trading journey and have a good day. Love you all. Bye.